Hello and welcome back to the Note. Well, we had the long-awaited unemployment data today for the US, and as I largely predicted yesterday, they had almost no effect on expectations for the Fed. This is in fact the same chart that we showed you yesterday because it barely even moved. It's the expectations for or the probability derived from the Fed funds futures market of a rate rise later this month. It stands at this moment at exactly 28% for those who are interested. As for the securities which are most directly affected by rates, you saw the dollar weaken very slightly indeed against its major trading partners. You saw bond yields move only very slightly. You did have a bad day for stocks, which might have implied that the chance of a rate rise had increased, but they remain comfortably above the lows they put in the beginning of last week on so-called Black Monday. Let's take a look at one security though where there was a very emphatic move, and that is the Rand, which today dropped to a new historic low against the US dollar. Obviously, the South African Rand is the archetypal commodity-backed currency, helped by South Africa's copious supplies of gold. And this is typical of other emerging market currencies, which are very much linked to the prices of metals, as we can see if we take a look at the next chart, which compares the Bloomberg Metals Index with the JP Morgan Emerging Market Foreign Exchange Index. A remarkable, inexorable decline which has become pronounced in recent weeks. This is largely driven by concerns about China. It's exacerbated by fears that a Fed rate rise would make the pressure all the greater. This is what could put pressure on the Fed. There's really no new US economic data coming between now and their decision on September the 17th that would really change their minds about this decision. They need to ask whether there is a real substantial risk that raising rates could create the kind of financial accident that could ultimately have real effects on the US real economy. If they decide they do that, they decide that there is a risk of that, which could happen if you see further falls in emerging markets, then that will very much increase the pressure on them to defer raising rates yet longer.